promised, Chandra has joined us from YPM. So she's going to be talking a lot about financials. She's going to talk a little bit about some ratios as well. And I really encourage you guys to talk about specialists all the time. This is another one. I heavily encourage you to ask questions if you do have them. She started with YPM in 2005. You got her CA designation in 2008. Are any of you familiar with the CA program? By show of hands? Extremely intensive for anybody that's gone through it. And you learn a whole lot about business and a whole lot about business financials as well. Accountants are specialists in business. So a large portion of our clients are small and medium-sized manager-run operations in Lethbridge and Lethbridge area. And she's also a member of a group called Spark through the YPM firm as well. Spark is focused on value-added services. So what that means is they are not necessarily just an accounting firm. They can also help with strategic planning. They help with reviewing profit improvement potential. They can help facilitate management team meetings, which depending on the organization you're in can be a headache. And that's where they come in to kind of help you out. She's also the manager of the accounting tech department. So they have a lot of bookkeepers available for their clients, and a lot of those services, they're very client specific. So they like to get down, talk to you, get to know your business as well. And they go through a whole range of things, including bookkeeping training, troubleshooting, QuickBooks, Sage, and if Sage is what we use, and oh my goodness, I do not understand that world of things, but that's luckily where partners and people like Chandra come in. So without further ado, let's have a big round of applause for Chandra from YPM.
Hi, well, thanks for letting me come and speak to you today. The title's maybe not great. It's called Understanding Your Financial Statements, but I'm not only going to talk about financial statements. I'm going to talk about ratios, which generally you pull out of the financial statements, and then just some other general business topics. So again, my name is Chandra Doe. I'm a manager at Young Park McNabb, and I've been there for 11 years, so I've been doing this for a while. So the topics I'm going to cover today are financial statements, ratio analysis, budgeting, and profit improvement. So why do you care? If you don't have good financial records, it's hard to make great decisions. If you don't know what the numbers are telling you, you're going to go with your gut, and that's maybe not the best way to do it. I actually looked at a U.S. national survey. I couldn't find a Canadian one, but it showed that only 25% of small business owners can actually read their balance sheet, and less than 10% understand their statement of cash flows. So that's kind of scary if you're thinking about they're trying to make decisions based on these financial numbers, but they don't really understand what they're telling them. And then a recent blog I read said, if you're like most small business owners, you bring your stuff into your accountant once a year. You don't ask her for help because she either doesn't explain things well or she makes you feel stupid when you ask a question. In fact, you're not even sure how these statements relate to running a business, and you ultimately brush them off because you think you have a good idea of where your real numbers are. But what this means is that you're making financial decisions based on your emotions, and ultimately it might not be the right decision. If you have timely financial data, you can make more timely decisions. So if you're off course and you don't know that your numbers are telling you that, you might just stay the course, and then at the end of the year you find out you lost a whole bunch of money and you're not really sure why. Whereas if you're looking at those more often, you might be able to say at 6 months, you know what, things aren't going the way I'm thinking they should be going. I need to change some of my decisions. Improve your bottom line and increase your credibility with banks. It's hard to get financing if you can't give them financial data, or if it's really late financial data, or if it's really messy. I mean, banks look at that, and that's how they determine whether they're going to lend to you. So here's the average business owner. So Bob owns a construction company. He's really knowledgeable about the construction industry. He's active in the business side of things, and he's very good at what he does. He has trouble with the number side, and he's trying to grow his business, but he's struggling. And this is a common scenario for a lot of business owners. So I'm going to start going through your financial statements, and I'll explain each statement, and then I'll kind of show you an example of it. I'll also show you what some of the numbers that pop out at me are. So the balance sheet, it's a snapshot of your financial health at a point in time. So it's always going to be dated. If you have a December year end and you're looking at your December financial statement, that's what your numbers are at that date. As soon as the next day rolls in, it changes. Your bank balance changes, your accounts receivables get collected, those kind of things. So it just basically gives you a snapshot. And the basic formula is your assets equals your liabilities plus your shareholder equity. So assets are the amounts that your company owns. Your liabilities are the amounts that your company owes someone. And your shareholders' equity is the amount that you have invested into the company as the owner. So here's an example of a financial statement. That's kind of squished. Hopefully you can kind of see it. So in your financial statement, some key things to note. You've got your assets on top, your liabilities, and your equity below. The two, let's see if I can actually use this pointer. So the two will balance, that's why it's called the balance sheet. At the top in your assets, it's sorted by liquidity. So your cash, obviously very liquid, you can go out and spend it. Your marketable securities, again, you can cash them out, you can spend it. Then it starts to get a little less liquid. So your accounts receivable, yes, you should get that cash, but you have to wait for somebody to pay you to get it. So it's not quite so easy to get that cash out. Work in progress, so that's essentially a category of inventory, and then inventory. Again, you can get your cash back, but it's not available right now. You have to liquidate that inventory to get that cash out. And so you've got your current assets on top, and then your sum of your current assets is $600,000. And then you've got your capital assets. So these are assets that you've purchased in your business: buildings, vehicles, computer equipment, furniture, fixtures. These are all things that are going to last more than 1 year. So they're an asset of your business, and you carry them at what you think. It's called net book value. It's basically what you think the asset's kind of worth at the time. So you're going to decrease it as you use up that asset every year. On the liability side, this is usually sorted by based on what you need to pay first. So you have your accounts payable and liabilities. So these are amounts that you owe your creditors. GST payable, income tax payable, sometimes you'll have source remittance payable. Those are all payables to the government, which also need to be paid within 1 calendar year. And your deferred revenue, so that's revenue that you've collected from somebody, but you haven't provided the service that they've paid you for yet, which is why you can't recognize the revenue. And then your current portion of long-term debt. And the reason you break out your current portion and your long-term portion is because to know where you're at, if you group it all together, it's a little bit difficult. If we break it out like this, I can tell that within the current year, you're going to have to pay $500,000 of liabilities. The remainder is more long-term. You have more time. So if I was to put that whole $245,000 of long-term portion up, it skews what the financial statements are telling you. And then you've got your shareholders' equity. So your common shares, these are the shares that you own in your company, and they're going to fluctuate. The value of the shares are going to fluctuate based on what your company is worth. It's always going to carry out what you originally paid for them, but they're worth what your company is worth. Preferred shares, however, are set. So they're all going to have a redemption amount, and that will never change. So it's sort of a different type of financing. And then your retained earnings is essentially the profits that you've reinvested in your company. And it will give you a really rough idea of what your company is worth, but it's a really rough idea. Okay, so does anybody have any questions on the financial and the balance sheet? Can anyone tell me what some things that maybe pop out are?
So I have a question. So if you're concerned about the balance, do you just tweak the value of your capital assets then so everything balances? Because really
it will balance, because basically the offset is your retained earnings. So your assets minus your liabilities equals what you've invested into the company, because you've left those assets behind, or if sometimes it'll put you into a deficit, meaning that you kind of owe your company.
So that's where the balancing piece comes from, right? Like there's got to be some place where you...
Yeah, it's the retained earnings.
Okay, thanks.
Yeah.
How do you go with the valuation of intellectual property?
They don't really show up on the financial statement unless you've purchased it from somebody else. So if you have a really great idea and it's worth $1 million, it doesn't show up on here, which is why I say that your retained earnings is a really, really rough idea of what your company is worth. Because if you have a really great trademark, if you have some patents, those don't get assigned a value unless you've paid somebody else for them, because then that cash going out is the value assigned to it. So that's why when you go to sell a company and you think you have sort of those intangible assets, that's why you have to get a valuation performed, where you have a certified business valuator come in and try and assign a value to that intangible asset component. Does that answer your question? Okay, so I'll tell you some things that I notice off the bat when I look at these financial statements. So the first thing is Bob, if this is Bob's company, is probably going to have a cash crunch in the next year. He's got $15,000 of cash, but he's got $255,000 of payables, $30,000 of GST payable, which when you owe CRA money, they make sure they get paid, and income tax is payable. So he owes a lot of money, and he only has $15,000 of cash. And yes, he has receivables of $169,000, but that's also a concern because his receivables went from $78,000 last year to $169,000 this year. So are there some collection issues? Are there some accounts that maybe need to be written off? Does he not have a very good collection policy? Because sometimes that receivable number can be a little bit misleading if they've got bad debts in them that haven't been recognized. Another thing that I noticed is the work in progress. So it's a really large work in progress, which means he has to finish it because it's in progress, it's not done. So he's going to need additional funds to complete that inventory item before it's ready to be sold. Another thing that I noticed is the deferred revenue. So this is funds that he has collected before a project has been done. So that money he hasn't earned yet, but it's been spent because it's not sitting in his cash. So that's a concern as well. And then the other thing that I noticed is that he's invested in his capital assets. And the way he's done that is by taking out some more long-term debt. So just a quick glance without knowing anything about what's going on in this company, I would have some reservations.
What was the marketable statements or securities?
Oh,
What are
securities. Those are investments that can be cashed out. So if you have GICs, or if you have like short-term GICs, or if you have just investments that can be cashed out, like if you call your banker and you say, cash these investments, I need the money back, that's what they are.
Would RRSPs fall under that?
No, because you wouldn't have RRSPs in your company. Those would be a personal asset.
Okay.
Is payroll have anything to do in this, or?
There might be payroll liabilities in the accounts payable. So he might owe money to his
accounts payable.
employees, he might owe some money to his subcontractors. I'm guessing that's probably part of what's sitting in that payables amount. Okay, so then the income statement. So the income statement is a financial report used to show the financial activities of the business for a period of time. So where the snapshot is just as of one date, the income statement shows it's generally for a year. It can be whatever period you decide you want it to present in. When you get your annual financial statements, it'll be for that fiscal year. And then one thing to note with income statements is that it's done on an accrual basis, not a cash basis. And this is something that trips people up a little bit. So I might show $500,000 of sales, but I might have $250,000 of that sitting in receivables. So I haven't collected that cash, but I've recognized the sale. Another thing is inventory. So maybe I've bought a whole bunch of inventory, I haven't sold it, so I'm not recognizing the expense, the cash out on my income statement because it's sitting on my balance sheet. Deferred revenue is another one that's same thing. I've got the cash, but I'm not recognizing the revenue because I haven't earned it yet. Does that make sense, or does anybody have any questions on that? So here's an example of what an income statement looks like. So you've got your revenue on top, your cost of sales. So your cost of sales are expenses that are driven by the sales. So they're things that are going to be directly impacted by the sales. So for example, in Bob's company, purchases. These are supplies that he purchased to make a sale, to do a building. Wages and benefits, it's gonna be driven based on how much work he has, because if he has more work, he has to pay more hourly wages. Same with subcontractors, if you've got a lot of work and you have to subcontract out, it's gonna be driven by those sales. And then, so your total revenue less your cost of sales is your gross margin. So this is the money that you now have to put against your fixed expenses. So he's got $490,000 that he can put against his expenses, which are generally not driven by the sales. These are a lot of times fixed, they're not impacted. So management wages are down here because as a manager, you are probably going to pay yourself whether or not there's the work. I mean, within reason, if you're not making any money, it's harder to pay yourself, but rent is fixed, right? Like, it doesn't matter how much you sell, you have to pay that monthly rent. So he's got $330 of fixed cost, so his net income before taxes is $160,000, and then he's gonna have his income taxes that he owes, and then his net income is $135,000. So the bottom portion there is actually a statement of retained earnings. So at the beginning of the year, he had kept in his company and reinvested in his company $286,000. Then this year he said, you know what, I'm gonna take some of my equity that I've invested, which is that dividend. So dividends are a below the line item. So if I paid myself a management wage, that would be an expense. But dividends are not considered an expense. It's an allocation of the equity that you've earned in your company. So they're taxed differently in your personal hands, and I'll get to that a little bit, I think, on my next slide. So at the end of the year, Bob has $392,000 that he's kept in the company and invested in his company. So, does anybody have any observations about this? There's a couple things that jump out. So, the few things that jump out about this financial statement with me is that his revenue went up, which is great, except for his gross margin percentage went down. So that means that he has to make more sales to keep that gross margin amount at the same, to apply to his fixed cost. And so here, it's a good idea when you're working to know your benchmark for your industry so that you can compare yourself to industry standards. So if construction industry, say, is 32.5%, then he's below that. So he needs to figure out why he's not on line with all the other construction companies. Maybe he's paying his guys too much, maybe he's subcontracting too much, maybe he has people sitting idle and he's using subcontracts. Maybe he doesn't have the best purchase contracts and he needs to renegotiate with his suppliers. So there's a few things there.
So for this income statement particularly though, if he's the sole manager, he may have chosen to pay himself a bit higher of a wage that past year.
Yeah.
Because his management wages are higher, and that's gonna affect his gross margin. So really his gross margin wasn't that affected.
It doesn't affect his gross margin, but it's good that you picked that, because that was the other thing that I noted, was that he decided to pay himself quite a bit more this year. So that impacts his income, like his net income, but his
Yeah.
gross margin is just based on these numbers.
Oh, okay.
So the management wage is below that calculation. So he still has some issues with his cost of sales, but yeah, he also decided to pull some more money out, which, as the owner, he's still making money. He's entitled to pay himself if he wants to. So that's not necessarily a concern. It's just something to be aware of. Okay. So shareholder remuneration. So this is what I was talking about before. As the owner of a company, you have options on how you want to pay yourself. So you can pay yourself through a dividend, or you can pay yourself through a wage. And there's some things to consider when you're doing that. So tax deductibility. Wages are tax deductible in the company, dividends are not. CPP benefit when you retire, if you want to collect on CPP, which some people say, you know what, I don't want to pay into CPP, I don't really have faith that it's going to be around when I go to retire, then choose dividends versus wages. Because with dividends, you don't pay into CPP. Wages, you do. RSP contribution room, same thing. Dividends don't contribute to your RSP contribution room. Wages do. Monthly remittances, if you want to pay your wage, or if you want to pay your remittances to the government for your personal tax, I mean, you can send in installments if you do a dividend. If you do payroll, you're required to send in those remittances.
So, for a not-for-profit business, you can't, or can you take out dividends? Because I think our original plan was to have dividends just reinvest back into the same business. Is that,
Not-for-profits aren't usually owned by an individual, it's usually a society
corporation or something?
Yeah, like it's usually not specifically owned by one person. You might have memberships, so every member is an owner. So in that case, you don't really pay out dividends. Like
Okay, so
you'll
just
never
be-
see dividends in a
so just a
non-profit.
different kind of shareholder?
This is a for-profit company, so he's pulling out what he's earned in the company. Nonprofits, they have a different.
Structure?
Yeah, I mean the structures may be similar, but they have for a for-profit, your goal is to make money.
Mhm.
A nonprofit, their goal is to reinvest it in what their purpose is. So it's a little bit different. Flexibility with respect to income splitting. The CRA requires, oh, I'm sorry.
I was just wondering, like, for the, your own personal income tax, the dividends versus wages, which, like, I don't know what you can claim or what you have to pay for your dividend payouts, like, your own personal income tax
On your own personal. Okay, so yeah, so that overall tax liability. So because in the company it's deductible, CRA recognizes that you have paid no tax on that revenue. So they're gonna tax you at whatever your normal rate is as if you were an employee to anyone. Dividends, however, because they've already been taxed in the company and the tax rate in corporations are 14% right now. So because CRA recognizes that you've already paid 14%, dividends are taxed differently. They're basically taxed, and it's not a perfect calculation, but they're basically taxed at the difference of what your tax rate is and what the company tax rate is. So that at the end of the day, it's supposed to be, the overall tax liability is supposed to be the same no matter how it gets paid. So CRA is gonna get the same amount no matter how you choose to pay yourself. And you're not, and some people are very concerned with dividends, like I don't wanna be double taxed because I've already been taxed in the company, but it doesn't work like that.
So there's no real advantage personally?
No,
Which way you
it's
go, it
really a
would be for
personal
your-
preference. A lot of people I have do dividends because it's easier. They can just declare a dividend at year end and then they don't have to worry about monthly remittances. They don't want to contribute into CPP for personal reasons, so that's fine. There's flexibility with income splitting as well. So as an owner, it doesn't have to, because it's not a deduction in the company, it doesn't have to follow the same standards as expenses do. So CRA's guideline is if you're paying a wage, it has to be reasonable. So if I hire my spouse and he does nothing and I pay him $100,000, that's not reasonable. So CRA will come in and disallow that expense. But on a dividend, if I set him up, like if he buys into my company and I have him as a shareholder, I can declare a dividend to shareholders because I'm allocating what the company has earned. Does that make sense? Am I losing it? Okay, so the next one is cash flow statement. So again, this is the statement that less than 10% of people understand. So basically what it does is it shows the cash impact of your financial activities in your business. So where I was saying that the income statement is done on an accrual basis, this sort of ties it back to how it impacted your cash. So it basically is going to show you whether your business is generating cash to meet current and future needs. So this is the statement. It's broken into 3 parts: cash from operating, cash from investing, and cash from financing. So cash flows from operating, it's very important that this be positive. So you'll see you start with your net income, and then what it's doing is it's backing out the non-cash transactions and the cash impact of balance sheet accounts. So first I'm going to take out amortization because that is a non-cash expense. That's me allocating a little bit of expense for those capital assets that I bought, and I might have bought them 5 years ago and I'm just using it up. The change in the non-cash working capital items, so this is where things like my accounts receivable. I've recognized the income, so in my net income are all of my receivables, but I haven't collected any cash. So it's taking into effect the cash impact of those transactions. So then at the end of the year, Bob has made $72,000 of cash. That's cash in his pocket from his operations. And it's very important that this be a positive number. A company cannot operate for very long if it's not earning money from operations, because the next two cash flows are almost always negatives. So the next one is your cash flow from investing. So in this year, Bob bought $264,000 of capital assets. He's buying those assets and he's investing in his company by purchasing those assets, but it's cash going out. He's having to pay for them. And then the next one is financing activities. So where I said that it's almost always negative, this one is actually positive. But if you look, it's because he took out proceeds of long-term debt. So he took a new loan of $220,000. And then next year, assuming he doesn't take any more long-term debt, it's going to be repayments. So it's going to be negative. It's going to be using up that cash. So you can see where if you don't have the cash from operating, it's really hard to finance. It's really hard to reinvest in your company. It's really hard to make those financing payments. And then the bottom there just takes your cash from the beginning of the year and your cash at the end of the year, and then kind of shows how that totals. Okay, so now I'm going to jump into ratios, but I guess before I do that, does anybody have any questions regarding the financial statements?
The first one, the balance statement, it's for a certain point of time, right?
Right.
So how do you compare it to the year before? What point of time are you using from the year before?
You want to pick the same point in
same,
time,
okay.
so that you have a fair comparison.
That's what I was wondering.
But you could also, depending on what kind of analysis you're trying to do, like if you wanted to say how does it compare to last month, you could go December versus November. Like you can compare it however you think that's going to be valuable. But generally, when an accountant does your statements, it's going to be for this year and last year, and that's where your comparisons are going to be for the same point in time. So you can say I ended the year like this last year, and I ended the year like this year. So for ratios, there's 4 common types of ratios. There's profitability, liquidity, asset management, and debt management. So basically when you're looking at ratios, you want to follow the trends. So you can't just look at one ratio. You really have to kind of look at a few and say, like, am I improving? Am I declining? Maybe look at industry benchmarks. So where do I land as far as the norm for my industry? So the first one is profitability ratios, and as it suggests, you're just basically measuring how well your business is performing and its ability to generate earnings compared to its expenses. Generally, higher is better, and this is the one thing that's confusing with ratios, is that sometimes higher is better, sometimes lower is better, so that gets a little bit tricky. Some common profitability ratios include gross profit margin and return on equity. So I'm not going to go through both, but I will just quickly go through gross margin or gross profit. So this measures how much money is left over from your revenues after accounting for those costs of goods sold. So those expenses that are impacted by sales, that's your cost of goods sold. So again, higher is better, and it's calculated by gross margins divided by sale. So here's Bob's financial statements again, and I've done the gross profit margin calculation for him for 2009 and 2010. So what this is saying is that for every $1 of revenue earned, there's 29 cents left to cover my fixed costs. So, which is good because he at least has stuff to cover his fixed costs, but it's declined from the last year he had 36 cents per $1 earned to cover it, and now he's got 29, which means he has to make that many more sales to get where he was. On liquidity ratios, it's the degree to which an asset can be easily converted into cash. So higher means less liquidity risk, but if it's too high, and this is again where ratios get tricky, it may indicate that you're not actually using your cash in an effective way. So if your company has just a ton of idle cash sitting there, that's great. You're obviously doing well because you're making a lot of money. But it means that you're not reinvesting it in assets. You're not maybe investing it in something that's going to earn you some money, because holding it in a bank account doesn't make you anything. You're maybe not growing because growth takes cash to fund. So that's where it's a little bit of a balance. And some common liquidity ratios include working capital and the current ratio. So I'm just, again, going to pick one. So I picked working capital. And it's not really a ratio, but it's an estimate of how much money your company is going to have to use over the next year. So it's your current assets minus your current liabilities. So again, if we go back to Bob's statement, last year, if we take the current assets minus the current liabilities, last year he only had $40,000 to play with. This year, assuming he can collect all those receivables and sell that inventory and that work in progress, he should have $104,000 of cash left. So then asset management ratio, this measures how effectively your business is managing their assets. So 2 frequently used ratios include the days sales in receivables and the days sales in inventory. And I'm actually going to go through both of them because I think that they're both pretty useful. The days sales in receivables tells you the number of days it takes on average for you to collect your receivables. So how soon are you getting paid after you do the work that you're doing? So generally lower is better because it means you're collecting faster. In some businesses, you may never have receivables. So if you own a coffee shop, you're not going to let the person leave with a coffee and then invoice them $5 in a month, right? Like they're going to pay you right away. So maybe you have no receivables. And then it's calculated by taking your AR divided by your sales and then timesing by 365 days for the year. So if we take Bob's, last year he was turning over and receiving his receivables every 21, just about 22 days. And this year it's every 36 days. So what that means is that his customers are slower to pay, and he should probably be looking into why. So some things that I like to say with receivables is you should probably outline your collection policies ahead of time. If you're in a business where you're going to be billing customers after you do the work, and you want to charge them interest or you expect collection in 30 days, you have to have that policy in place and you have to let your customer know that. So you say, I'm going to invoice you, I expect payment in 30 days, if I don't get it, I'm going to start charging interest. Because it's hard to do that after, where you're like, oh, I'm just going to start charging you interest then, and they're like, well, I didn't agree to that. So bill quickly, and if possible, progress bill. So if you have a big project and you're halfway, if you're in the halfway point, send them a progress bill for that halfway point. Bill quickly. Bills aren't fun, so people will sometimes put them off, but then you're not getting paid, right? So once the job is done, send that bill right away. Send notices if you're not getting paid. Sometimes I have clients who have receivables who have sat for quite a while, and it's like, have you followed up with these people? Well, no. Well, do they? Maybe they don't even know they owe you money. Again, charge interest or penalty fees for late payments. Think of it this way. When you have receivables, you are financing your client. And if you're not charging anything, then you're financing them for free. So, I mean, it's fine, but you just want to watch that. So then days sales and inventory is sort of doing the same thing. It tells you the number of days it takes on average to sell your inventory. So again, lower is better. And the calculation is the same except you swap out receivables for inventory. So again, if we look at Bob's, last year he had every 19 days he was basically rotating through his inventory. So he was selling it quite quickly, which is good. This year it's taking him close to 77 days to rotate through his inventory. That's high. So that means he has a lot of his cash tied in inventory, which is not really a liquid asset. So it's hard to access that cash once it's locked in inventory. So with his industry, maybe that's more of the norm, and it's very industry specific, but that is something to watch. And again, you don't want too low of a number because it might mean you're missing out on sales. So if your day sale and inventory is 5 days, maybe you're actually losing sales because you don't have enough inventory to keep up. So it's not necessarily that you want as low as possible, you just want to manage it. And then debt management ratios. So this measures the extent to which the company is financed through debt. And these ratios will help you see some early signs of solvency problems and assess your risk of default. So there's debt to equity and there's debt service as some commonly used ones. So I'm just going to go over the debt to equity. So this measures the financial risk of a company. Generally, the higher the ratio, that means there's more risk because it means you have more debt. So it's your total liabilities divided by your shareholders' equity. And so again, if we look at Bob, so it doubled this year. It's still not incredibly high. It's only 2 to 1. But what that means for every dollar that he has personally invested in the company, the bank or his financiers have 2. Okay. And then another thing to be aware of is when you get financing, you'll want to look through the agreement because a lot of banks have their own covenants that they require you to meet. They have their own ratios, and they'll usually explain to you how to calculate them. But it's good to know it because if you default in it, a lot of clauses in your debt agreement say, if you default on this covenant, I can call your loan. So it means that long-term portion is now current, and you have to somehow find a way to pay it. So you want to know those ratios, and you want to make sure you're on top of them. Anything on ratio? Any questions? Okay. So I'll jump into budgeting. So budgeting is important. Again, it's maybe not the most fun thing to do, but it's important. It looks forward and tries to predict the financial impact of possible actions. And it gives you a look at what-if solutions or situations and tries to maximize the financial gain and minimize financial loss. And it basically kind of gives you a roadmap for the year. So you can kind of see where you think you're going to be. And again, budget. You want to budget realistically. You don't want to say, this is my first year of business, but I'm going to pull in $500,000. I'm going to have minimal costs. I'm going to make a ton of money. Because that's not realistic. So, and then you want to look at it. You want to do comparisons. So you might want to do a monthly comparison to your total budget. You might want to do a monthly comparison to a prorated version of your budget to see, okay, so I have 12 months in my budget, what do I expect to receive and pay each month? It's very specific to however you would find it useful, but it's a good thing to have. And if you're going for financing, a budget and a financial projection is usually something they want to see. It gives you some credibility with the banks. Whoops. So one thing is job costing, and this isn't something that everyone would have to do. It's very specific to industries where you have to quote on jobs. So for Bob, because he's in the construction industry, this would apply. It's basically saying, what is this project going to cost me? What do I want to make at the end? And then what do I need to make so that I can apply it to my fixed costs so that at the end of the year I make some money, or at least I don't lose some money. So you kind of work backwards from your costs, know your contribution margin, so what's left over after your variable costs. One thing that people find very confusing is that your markup is not your contribution margin. So most people say, well, I'll just mark it up by 15%. But it doesn't work like that, because then what it actually, if you mark it up by 15%, your contribution margin is only about 13%. That's kind of how the math ends up working. And then, yeah, it's always important to cover your fixed costs. And this is something that people don't often, I shouldn't say often, they don't all do when they should. So I have had construction companies get to the end of the year and lose a bunch of money and then go back and do this to try and figure out why they lost money. And they were missing things in their quotes, and like big things, like they quoted a project and they forgot to quote for floors. Well, I don't know very many buildings that don't have floors. So it's, and then after the fact, like you're doing it at the end of the year, you can't fix that. You can't fix the issue in your process because, you can for the next year, but you've now lost out on a year of maybe quoting badly. So, and then break even is another important number to know. And this could be if you're just selling item or time or however, but it's basically the units that you need to sell to break even, where you're not losing money. So this is a good number to know, because if you have one product and you're selling it for $5 and your contribution margin, if you're making 20 cents on that, how many do you need to cover your fixed costs? Like that's sort of what it's trying to figure out. So it's your fixed cost divided by your contribution margin, and then your contribution margin is your sales less your cost of sales divided by your sales. Sorry, this is getting a little bit technical, and then if you want to reach a certain profit level, you can do this same formula, but on your fixed costs. You say, okay, here's my fixed costs. They're going to be $500,000 for the year. I would really like to end the year making $100,000. So you would say 500 plus 100,000, and then you put that in your fixed cost category. And then do the same calculation, and that's gonna tell you how many units you need to sell to get your desired level of profit. So another thing that we use quite a bit, and a lot of times through the Spark group that Jason was mentioning at the beginning, is KPIs. So they're key performance indicators, and sometimes these are ratios and they're financial, and sometimes they're non-financial. So they might be things like employee turnover, new customers, repeat customers, customer satisfaction, things like that that are not necessarily financial, but it's a way that you're measuring your performance and your success. So it's basically, and you don't want to do a ton of these, like if you decide you want to measure 20 KPIs, then you'll end up measuring none. So what I say is, find 5 or 6 main ones. Like these are the things we have to get right to succeed, and then those are the things you should be tracking. And then factors increasing profit. So, I mean, there's obviously, you can increase your price, you can increase your sales volume, you can decrease your cost of materials, add as a percentage of revenue. So automatically decreasing your cost of materials is not necessarily a good sign, because it means maybe you're not selling as much, so you don't need as much. But if you're still making that same amount, but you're being more efficient, then that's great. Same with labor, or decreasing your fixed cost. And then I think this is one of the last things that I was going to cover. It's 4 ways to grow your business. So this is a tool that we use with people. So as a small business, it's really hard to prioritize and to focus, because there's a million things that you should be doing or could be doing to improve. So this kind of helps categorize them, adds a little bit of structure to your ideas, and then hopefully helps prioritize them. So we always say there's really only 4 ways to grow your business. And under that, there's an infinite number of possibilities, but there's really 4 main categories. You can increase your number of customers of the type you want. And I say of the type you want is because you don't want every customer. And when you're starting out, it's hard to get your head wrapped around that, because you think, I want everybody. I'm going to cast a wide net and I want to sell to everyone. But if they don't pay their bills, if they're really high maintenance and they end up costing you money, maybe those aren't the right customers for you. So does anybody have any ideas of what you could do to increase the number of customers that you have?
Advertising and, marketing.
Yeah, have a marketing plan, and make sure that it focuses not just on your advertising plan, but your full marketing plan. Like, who are you going to market to, and those kind of things.
Someone suggested something to, our massage class about word of mouth, where they said if you get one of those great customers that pays on time, there's never any issues, give them the incentive of, if you bring me 10 more paying customers, you get a free massage.
Yeah, referrals.
Exactly. And then you're getting customers kind of on par because it's their friends.
Yeah, they probably hang out with similar people.
Mm-hmm.
So if they're a good customer, they're probably going to refer people who are good.
Mm-hmm.
And yeah, exactly. So a referral source. And Lethbridge, I find, is still a very small town feel. And so a lot of times word of mouth is an awesome way to get your name out there, and is more effective sometimes than putting an ad in the paper or trying to advertise on the radio. Because if I get told by somebody that I trust, you have to go and see this person, they're really amazing, I'm going to take that pretty seriously. So yeah, that's a great one. Anything else? So a couple other ones could be reducing your price. That gets people in the door. That's not necessarily the best plan. I'm not saying go in and slash your prices, but if you're trying to get maybe some new people, maybe do it as an incentive the first time you come in. I'll give you 10% off or something like that, just to get them in the door. And then partnerships and joint ventures. Like if you know somebody who has a service or a product that's a good fit with the maybe you partner up and try and get each other's clients. Then increase the number of times your customers come back. So that's pretty self-explanatory, but do you have any ideas of how you could do that? Loyalty programs. Oh, go ahead.
Yeah, well, on my business, I'm gonna do a subscription based. So, it's actually oil changes, so they have to come back, but I'm gonna keep their records. So, well, they don't have to come back, but
Yeah.
it's a better way to keep
Yeah.
track of it.
Yeah, exactly. And great customer service. that's a way to get people to come back. If you treat people right and have a good product or a good service, that will keep people coming back. And then increase the services or products you provide. So well, I guess that one's pretty self-explanatory too. And then also I have increased sort of along the same one is like increase the average value per sale. So increase your price is one, which conflicts with increase the number of customers. So you know, maybe you don't want every customer, but you want the premium customer, so you're going to increase your price. And then the last one is increase business efficiency. So any ideas?
Like,
Uh,
oh, sorry,
go
go ahead.
ahead.
Just running it smoother for the customer, if let's say bills sometimes might take a month or two to show up, maybe be able to bill them in a 2-week period or faster turnaround times, things like that.
Yeah, exactly. I'm sorry. What?
Well, like I'm going to do on-site servicing, so there I can look for other like extra sales, like if the light will be burned down and stuff, or air filter or whatever.
Yeah. So that would be like increasing the
Those,
services. Yeah. So I had exactly regular bill and collection policy. It can be as simple as remembering to turn out the lights, because this is sort of the catch-all. This is how do I lower my costs? So maybe it's better job costing and quoting. Maybe it's changing vendors because you're not getting a good enough deal with your vendor. And we've had clients who have used the same vendors forever, and then we've done analysis of their gross margin and done some profit improvement stuff, and we're like, well, what if you looked at your vendors and were able to get 1% off your cost of materials? Like, it hits the bottom line because it hits that gross margin. So those are good things to look at. And then I guess some of my closing points are, it's just, you can only manage what you measure. So if you don't know what your numbers are or what they're telling you, it's really hard to manage it and to know what maybe you should be doing that you're not doing. Timely information is important. Same with so this goes back to those guys who didn't quote the floor. Yeah, they found out about it, but they found out about it almost a year after, that their processes weren't working and they were losing money. If they had done that job costing 8 months earlier, they probably would have saved quite a bit of money. So it's important to have more timely information. And the same thing when you're looking at your financial statements and they're already 6 months old, you know, they're already losing value because they're not timely. Plan to start doing the right things. So, and then don't leave it to fate. One of the partners that I work with say, if you aim at nothing, you'll hit it with remarkable accuracy. So you want to have a plan and know where you want to be so that your decisions are being driven by that. And it's very hard as a small business. You get into it and you're doing, but you need to step back and work on your business and not just in it. You can't do everything, so you really need to prioritize and focus. What's going to make the biggest impact to my business? And then build a strategic plan based on that with who is going to do what by when. If you don't have those hard deadlines and steps in place, it won't happen. And then the other thing, partner with your professionals, and whether that's your banker or your lawyer or your accountant. Make sure you're getting things set up correctly at the beginning, because a lot of times I see people who say, I don't want to talk to a professional because it's going to cost me money and I'm going to do it myself. But then a year later they're calling me because CRA is breathing down their neck because they haven't filed what they need to file. They're not set up with GST properly. Their incorporation documents are a mess. They're arguing with their partner or their shareholder because they didn't set things up initially correctly. So sometimes it's more expensive to try and fix it. Well, actually I shouldn't say sometimes. A lot of times it's more expensive to try and fix it if you don't initially set it up correctly. So that's a recommendation. Does anybody have any just general questions? Doesn't necessarily have to be on the presentation.
Just from the last presentation, we were talking about sole and corporate and stuff. You know, I was planning on starting as a sole proprietor and then getting into corporate. Is it, you know, with my equipment costs, I was expecting to, we were told not to say losses, but break even. So it's going to be expensive. I was planning on using that as a tax. But is it still beneficial to incorporate?
There are some benefits to
plan loss.
incorporation. The two main ones are limited liability. So if something happens in your corporation and it's sued, the company is sued because it's a separate legal entity. So your personal assets are safe. The other benefit is the tax rate, which is, as I mentioned, it's 14% for corporations, and personal is higher. Even the lowest tax rate is higher than that. But initially, and for a lot of startups, I do recommend start out as a sole proprietor, because you're probably initially not going to be making a ton of money, and anything that you do make, you're probably going to need to pull out to live on. And as soon as you pull money out of your company, it loses that tax benefit, because now you're paying tax on the personal level as well. So I have some clients whose company makes a lot of money, but they pull every dime out. So they might as well be a sole proprietor, because they're not getting the benefits of a corporation, because they're not leaving anything behind. And then I always say too, with startups, because there's a risk that things won't go well, it's a lot easier to sort of wind up a proprietorship than a corporation, because corporation there's you have to file a notice of dissolution, and you have to, and then there's a lot more admin that goes along with having a corporation as well. You have to file a corporate tax return, you have to have a separate set of books, whereas a proprietor will file their taxes under their personal return. Then you can have the write-offs from any losses on your personal return. Assets that are purchased still get capitalized. So you don't amortize them all in the first year or expense them all in the first year. You do it over the life, and it's a prescribed rate that CRA sets out. So you won't get that. You won't, from your equipment, you won't get a huge write-off in the first year, but you'll get some, and then you'll get some every year following that. And then the other thing is, if you decide to start as a proprietor, and then you get to the point where you're like, you know what, I'm making tons of money, I don't need this all, I'm just getting taxed a lot personally, then we just roll it into a corporation. Like, you're not set in your structure because you started as a proprietor. You can roll into a company at any time, and you can do it on a tax deferred basis through a special tax election, which we do quite a few of at our firm. So.
No other questions? A big thank you.
It's because it's not, yeah, probably not terribly exciting stuff to go through, but it is important. I'll stress that. So.
Hugely important stuff. Let's have a big round of applause. You know, like she was saying, this is stuff that a lot of people don't necessarily find really enthralling. But I can tell you guys from personal experience, those ratios especially, whether it's, I've told you guys before, I've had experience in banking lending, I've had experience in alternative lending with Community Futures, I've had experience with massive lending through GE Capital. Every single lender that I have ever worked with looks at ratios. They are so important. And especially over a long period of time, the reason that we look at it as from the financial perspective, especially when we have that long-term kind of window, is for trends. Trends are so important to see where it's going from year 1 to year 2 to year 3. And if you take your stuff to anyone that's going to be giving financing to you, and you don't necessarily even know that those changes are happening in your business, then that can sometimes shoot up a red flag from the lender's perspective. Like I said, you don't necessarily have to be specialists, but you need to understand those finances. Just to give you guys an example, days in accounts receivable. I really liked her explanation on that, because if you are in an accounts receivable sort of situation, it is so important to control that. I have seen a lot of companies that are very successful, they make a lot of money, but because their accounts receivable is a nightmare, their cash flow is totally out of whack, and they're coming to me, a business that's making $470,000 a year, and they're coming to me for working capital because they just don't have any money in their account. And something I always recommend is, if you guys don't know necessarily what your business should be doing for that, look at how the big guys do it. GE Capital, I told you guys I worked for them, 5th largest bank by assets. They had $8 billion in a trust account that just sat there generating interest that they could lend out. What do you think their accounts receivable turnaround was to their people that they lent to? Any guesses? 30 days? 7 days. If I came and did an audit and you sold your product, if the money wasn't in GE's account after 7 days, you got in trouble. Your salesperson was on the phone with you saying, why didn't you pay us our money? And if there was a big problem where, oh, I don't have the cash, that's not a response to that. And so I'm not saying have a 7-day account receivable turnaround. Nobody's the size of GE and they can kind of bend some arms, right, and make it so that happens. But that just shows how important it is to have that sort of a thing under control. And talking about the covenants of the lender, every banker, whether at any bank that you go to, any lender that you go to, they're going to look at those ratios. They're going to look at them year after year because they want to know what your business is doing, how it's performing, because their cash flow is dependent on your cash flow. So as a lender, we do annual reviews every year. So do banks. They're going to call you every single year that you're with them with a loan, and they're going to do a review with you, and they're going to talk about, they're going to want to see your annual financial statements if you're a corporation. And they're going to sit down and they're going to take a look through and they're going to go through. And I use every single one of those ratios that she went through. I use them to evaluate businesses when we're doing an annual review. So they are very, very important. And break even, know your break even. So many people that I deal with, that's one of the first questions that I ask is how much do you need to sell so that you will not go out of business? Know that number because that can really form the basis for your strategy, especially when you're doing forecasting. Other than that, I absolutely fantastic presentation. There's not a whole lot else that we have to go over tonight, so I will let you guys go a little bit early. Next week, we're going to be talking about cash flow and funding. So we're going to have Morley Bell, who I work with. He has a lot of experience as a lender, as an entrepreneur as well. He's going to be talking about alternative lending from the perspective of a company like Community Futures, because we do lending a little bit differently. And we're also going to be joined by some partners that we have through RBC. So we're going to have their small business team in and talk about what lending through a bank looks like. Because I can tell you from seeing both sides of it that they are completely different things, okay? So we're going to be talking about that next week. If you guys have any questions, you guys have my email address, you have the phone number for the office, you can get a hold of us on Twitter or Facebook, whatever you guys need, reach out and talk to us, okay? And make sure that you sign those attendance sheets, and I still need the one from this side. I believe it's at the top there. Perfect. If anyone doesn't have their name on there, put your name on there now. And I think I told you guys this last week. I used to have a professor that told me, I'm going to give you back the greatest gift I could ever give you, time, because we're not going all the way to 9 tonight, so I'll give you guys a little bit of the time back that I stole from you a few weeks ago. So you are good to go. Thank you very much.